As you settle in tonight, let's start gently. We are not rushing into numbers or forms just yet. Instead, I want you to understand why taxes exist in the first place, and what they mean for you and for everyone around you. Imagine you are walking through your town or city. You see roads beneath your feet, streetlights above your head, and maybe a school or a fire station in the distance. Every one of those things is paid for with taxes. Taxes are simply money that people contribute together, so that a community can keep running. Without taxes, there would be no public schools for children, no police or firefighters to protect people, and no safe bridges or highways to travel on. When you hear the word taxes, it is easy to picture stress and paperwork. But at the most basic level, taxes are simply the way people share the cost of living in a society together. In the United States, this idea of shared cost goes all the way back to the birth of the country. In fact, taxes were part of the reason the nation was created. Long before America was independent, people were angry about paying money to a faraway government in Britain. That frustration helped spark the American Revolution. Once the United States was born, it created its own system for collecting money and paying for public needs. Now, in your life, taxes probably don't feel like history. They feel like forms, deadlines, and numbers you might not always understand. But here's the truth. Every time you pay taxes, you are participating in something much bigger than yourself. You are helping to make sure schools keep teaching, that hospitals stay open, and that services like mail delivery and clean water continue every day. So what does this mean for you? As someone about to learn how to do taxes step by step, it means that instead of looking at taxes as a burden, you can look at them as a process. It's a process you'll get comfortable with the more you practice. Just like learning how to drive a car or learning how to cook a recipe, taxes can feel overwhelming until someone breaks them down for you. That's exactly what we're going to do here together. In this lesson, you will slowly learn the flow of the tax process. You will discover how to gather the right documents. You will see how income is measured. You will find out how credits and deductions reduce what you owe, and how refunds happen when you pay too much in advance. Every step will be clear, and you will always know what you're doing and why it matters. For tonight, I want you to imagine yourself on a calm walk through this system. Picture yourself holding a small folder or envelope in your hands. Inside are the pieces of paper that tell the story of your year, the job you worked, the money you earned, and the small details like whether you went to school, owned a home, or supported a family. Each of those details matters. Each one plays a role in how your taxes are figured out. As you learn, you will see that doing taxes is not a single giant task. It is a series of small, simple steps. You gather your information, you enter it carefully, you check to see if you qualify for benefits like credits or deductions, and finally, you see if you need to pay a little extra, or if the government owes you money back. The important thing is this: you don't need to know everything at once. You only need to understand one piece at a time, and each piece builds on the one before it. By the end, you'll be surprised at how it all makes sense. So, as you lie back and listen, let this beginning sink in. Taxes exist so that life in your community can keep moving. They are not here to scare you, but to support the things you use every single day. In the next part, we'll start gently looking at the first real step you'll take when preparing your own taxes, gathering your documents. But for now, simply let your mind rest on this truth. Taxes are just the way we all share the cost of living together, and when you learn how to handle them, you'll have one more skill that makes life smoother, calmer, and more in your control. Now that you understand why taxes exist, let's take the first practical step together. Doing your taxes always begins with one simple task: gathering your documents. Think of this part like packing a bag before going on a trip. You wouldn't start walking toward the airport without your suitcase, your passport, and your ticket. In the same way, you cannot begin filing taxes without the right papers and records in front of you. So let's imagine this calmly. Picture yourself sitting at a desk, maybe with a soft light beside you. On that desk, you have an empty folder waiting to be filled. Tonight, we're going to walk through what belongs inside that folder. You don't need to rush, and you don't need to have everything memorized. Just follow along and let the details settle in your mind. The first thing most people need is the paper that shows how much money they earned from their job during the year. If you worked for an employer, meaning you were hired by a company and received a paycheck, your employer will give you a form at the end of the year. That form shows your total earnings and also the amount of taxes that were already taken out of your paychecks. For many people, this is the single most important document to collect because it tells the story of their job in numbers. But maybe you didn't only work one regular job. Maybe you did side work, like driving for a rideshare service, freelancing online, or selling items where you were paid directly. In that case, you may get a different kind of form that shows that income. Or sometimes, you may not get a form at all, and it's up to you to track and report what you earned. This might sound stressful, but remember, every dollar you earned has a place in your tax return. Nothing is too small or unimportant. Next, let's think about money that comes from other parts of life, not just work. Maybe you had a savings account at a bank that paid you a little bit of interest. Maybe you owned investments, like stocks, and you sold some during the year. Maybe you collected rent from a property you own. Each of these things creates its own piece of paper. All of them matter, because the government looks at the complete picture of your income, not just your paycheck. Now, let's move on to life details that can lower your taxes. For example, if you paid for college classes, there are papers that prove you spent money on education. If you own a home and pay a mortgage, the bank sends you a paper showing how much interest you paid. If you donated to charity, you may have receipts or letters that show your gifts. These documents are important because they may qualify you for deductions or credits, and those can reduce the amount you owe. Another part of gathering documents is proof of identity. You'll need details like your social security number, which is a unique number that identifies you in the tax system. If you have children or dependents, you'll need their numbers too. Without these, the system won't know who you are or whether you qualify for certain benefits. So, let's pause and think about what this folder on your desk looks like now. Inside, you might see papers from your employer showing your yearly wages, papers showing income from side work or freelancing, statements from banks, or records of investments, papers that prove you paid for things like school or home mortgage, interest, receipts for donations to charity, documents that confirm your identity and your dependents. It may sound like a lot, but remember, this is just the act of collecting. You are not solving a puzzle yet. You are simply gathering the pieces. And once the pieces are all in front of you, the puzzle becomes much easier to put together. Here's something to keep in mind. The act of collecting documents is usually the hardest part for most people. Once you have everything gathered, the rest of the process feels more like filling in blanks. But if you skip this step or try to rush it, you'll find yourself scrambling later. That's why it's best to treat this step as calmly as possible, as if you're preparing a small gift for yourself, future you, who will be thankful you were organized. If you feel overwhelmed, you can break the task into small sessions. One evening, you look for your job papers. Another evening, you check for your bank records. Another evening, you gather receipts for donations or expenses. By the end of a week, you may find that your folder is full without ever feeling rushed, and if you ever lose something or don't have a paper you need, there are ways to get replacements. Employers can reissue income forms. Banks can give you statements. Schools and charities can provide new copies of receipts. The important thing is not to give up if something is missing. There is almost always a way to find it again. So now, as you lie back and listen, picture your folder getting fuller and fuller with each document you collect. Each paper is like a puzzle piece. Alone, they may not make much sense, but together, they form the complete picture of your financial year. At this stage, you are not solving or calculating. You are just preparing, and preparation is half the work. Once your folder is full, you are ready for the next step in the process, understanding how income is measured and how the system decides what part of your income is taxed. But for now, let yourself rest, knowing you've taken the first calm, steady step on this journey. Life is full of big changes, and almost every major event has a tax effect. Let's walk through some of the most common ones so you'll know what to expect. Marriage is one of the biggest. When you get married, you can choose to file jointly with your spouse. This usually lowers your tax bill, though in some cases it can raise it. Filing jointly combines your income, deductions, and credits. Filing separately keeps things divided, but often results in losing certain benefits. Having a child also changes things. Parents can claim the child tax credit, which reduces what you owe, sometimes by thousands of dollars. You may also qualify for credits related to childcare expenses, and if your income is lower, the Earned Income Tax Credit, a new baby doesn't just change your daily life, it changes your taxes too. Buying a house is another milestone. The homeowners may deduct mortgage interest and property taxes, depending on their situation. If you sell a primary residence, there's often an exclusion that lets you avoid paying taxes on some of the gain. Going through a divorce also has tax effects. Who claims the children, how alimony is treated, and how property is divided all come into play. These details matter, and sometimes professional help is needed. Retirement is another big change. When you stop working, your income sources change, and so does how they're taxed. Social Security benefits may or may not be taxable depending on your overall income. Withdrawals from retirement accounts are taxed, unless they're from a Roth account. Even sad events, like the passing of a loved one, can have tax consequences. Inheritances, estate taxes, and the handling of assets all fall under tax rules. The key idea is this: when something major happens in your life, check how it may affect your taxes. The rules are built around life events, and being aware means fewer surprises when April arrives. One of the simplest but most powerful ways to make tax season easy is to stay organized. Instead of scrambling in April, you can prepare a little at a time throughout the year. The first step is keeping all tax-related documents in one place. That means W-2s from employers, 1099s from side jobs, bank interest statements, and receipts for deductions. Whether you use a folder, a box, or a digital system, the goal is the same. Make sure nothing gets lost. If you run a small business or freelance, keeping detailed records is even more important. Track your income and expenses carefully. Save receipts. Keep mileage logs if you drive for work, and record when and why you spend money related to your job. This not only makes filing easier, but it also protects you in case of an audit. Another helpful habit is reviewing your paycheck during the year. Make sure the right amount of tax is being withheld. If too little is taken, you'll owe later. If too much is taken, you'll get a refund. But that means you've given the government an interest-free loan. Adjusting your withholding helps keep things balanced. Digital tools can help too. Many banks and payroll systems now let you download tax documents directly. Tax software can import those files, saving you time. Think of staying organized as smoothing the road. Instead of hitting bumps and potholes at the deadline, you're laying down pavement all year long. Filing becomes less about searching and more about checking what you already have ready. The smartest approach to taxes isn't just looking backward, it's looking forward. Planning ahead makes next year easier and can even save you money. First step is reviewing this year's return once it's done. Look at where your income came from, which deductions you used, and whether you owed or got a refund. This tells you what to expect if things stay the same. Next, think about what will change. Are you getting a new job, having a child, buying a house, or starting a side business? Each of those changes your tax situation. Planning ahead lets you adjust early. Another step is adjusting your withholding or estimated payments. If you owed a lot this year, you might want to increase what's withheld. If you got a big refund, you might want to reduce it, so more money stays in your paycheck. Retirement contributions are also worth planning. If you didn't put much into a 401k or IRA this year, think about increasing it next year. That not only builds your future, but often lowers your taxable income. Charitable giving is another area. If you want to donate, keeping records and timing your donations can make them deductible. Planning in advance means you won't forget to save receipts or track the amounts. Finally, keep learning. Tax laws change over time, and small changes can have a big impact. Staying aware of updates, even just once a year, keeps you ahead. Think of tax planning like planting seeds. What you do now sets up what you'll harvest later. A little time spent adjusting today grows into smoother, less stressful tax seasons in the future. Now that you've gathered your documents and placed them neatly in your folder, it's time to move into the heart of what taxes are built on: income. Everything starts with income, because it's the foundation the tax system uses to decide what you owe. Think of income like the soil in a garden. Before anything can grow, before deductions and credits can be planted, you need to understand the soil you're working with. Let's take this step slowly. When we talk about income, we mean the money that comes into your life during the year. This is not only your paycheck from your job, though that's often the biggest part. It also includes money from side work, money from savings accounts, money from investments, and even some benefits or assistance. The government divides income into different categories. Each category has rules for how it is taxed. We'll walk through them one at a time. The first and most common type is wages or salary. This is what you earn when you work for an employer. Imagine a person working at a desk in an office, or on a shop floor, or serving customers at a restaurant. At the end of every pay period, they receive a paycheck. A portion of their earnings may already be taken out for taxes, and the rest is what they take home. That paycheck is the core of wage income, and it's recorded on the document your employer gives you at the end of the year. Next, think about income from self-employment or side work. Maybe you do freelance graphic design. Maybe you walk dogs for neighbors. Maybe you drive for a rideshare company on the weekends. All of that counts as income too. Unlike a regular paycheck, taxes are usually not taken out ahead of time. That means you will need to report the full amount yourself when tax season comes. It might feel like more responsibility, but it's really just the system trusting you to keep track of what you earned. Now let's move on to investment income. This includes money earned from savings accounts, where banks pay you interest for keeping your money with them. It also includes dividends, which are small payments you might receive if you own shares of a company. And if you sold investments during the year, like stocks or cryptocurrency, you may have what's called a capital gain or loss. A gain means you sold it for more than you bought it, while a loss means you sold it for less. Both matter, because the government wants a full picture of how money moved in and out of your life. Another kind of income comes from property. For example, if you own a house and rent it out, the money you collect from tenants is income. Even if you only rented a room or used a platform to rent your home for a few days, that still counts. The system treats property income as part of the bigger picture of your finances. There are also special forms of income, like unemployment benefits, or payments you receive from retirement accounts, or even winnings from gambling. These may not happen to everyone, but for the people who do receive them, they are important to report. Now here's where things get interesting. The government makes a difference between what is called gross income and taxable income. Gross income is everything. You earned all of it, without exceptions. Imagine it like pouring every dollar from the year into one big jar. Taxable income, however, is what remains in the jar after certain things are taken out, like deductions. We'll talk about those deductions soon, but for now, it's enough to know that your gross income is the starting point, and taxable income is what the tax is actually calculated on. Let's pause for a moment and think about why it matters to understand income clearly. If you forget to include something, it can cause problems later. because the government often already has copies of the forms your job or bank sent you. If they see you missed one, they may ask questions. On the other hand, if you include more than you really earned, you may pay too much tax unnecessarily. That's why this step is about balance, being complete, but also accurate. Picture yourself once again at your desk with your folder. Now imagine you take out each paper one at a time. You look at the form from your employer, and you say, "This is my wage income." You look at a statement from a side job, and you say, "This is my self-employment income." You glance at a paper from your bank, and you note, "This is interest income." Slowly, piece by piece, you are labeling the sources of income in your mind. This exercise might sound simple, but it is actually one of the most powerful parts of the process. It turns a pile of papers into an organized story of your year. You are no longer looking at random numbers. You are looking at the story of your work, your effort, your savings, and your financial choices. If you feel overwhelmed by all these categories, remember that tax software or a professional will usually ask you specific questions to guide you. They'll say, "Did you have income from a job? Did you have income from self-employment? Did you earn interest or dividends?" Your task now is simply to recognize the categories and know what they mean, so you're not surprised when you hear them later. One more thing about income that's important to remember is honesty. Taxes are built on trust. The system assumes you will report everything you earned, even if no one else is watching. While it may be tempting to leave out a small side payment, it's always better to be thorough, even if the number feels small. To you, the principle of reporting all income keeps the process clean and worry-free, so now you can relax, knowing you understand the foundation. Income is the soil. It is the raw material from which the rest of your tax return is built. You've gathered your documents, and now you can identify what type of income each one represents. Next, we'll talk about the other half of the story, deductions and credits. These are the ways the system reduces the amount of your income that gets taxed. It's like carefully trimming away parts of the soil to make room for seeds to grow. But for tonight, you've already done a lot. Rest in the knowledge that you understand how income is defined, and that you can recognize the different forms it takes. You are building a calm, solid foundation for the work ahead. Now that you've organized your income and understand the foundation of your tax return, it's time to explore one of the most important and relieving parts of the process, deductions and credits. This is where the system allows you to subtract or reduce part of your tax burden. Think of it like a lightening of the load you've been carrying. If income is the soil, then deductions and credits are the tools that help you shape and soften that soil so something good can grow. Let's take this step slowly, with care, because deductions and credits can seem complicated at first. Once you understand the flow, however, you'll see that it's just a matter of sorting what applies to you and what does not. The difference between deductions and credits. First, let's clear up the difference. A deduction reduces the amount of income that is taxed. For example, imagine you earned $40,000 in income, but you have a $2,000 deduction. That means the government will calculate your taxes as if you only earned $38,000. A deduction lowers the starting point. A credit, on the other hand, is more direct. It reduces the tax you owe, dollar for dollar. Imagine you calculated your taxes, and they came out to $1,000. If you qualify for a $500 credit, your tax bill drops to $500. A deduction lowers the soil before the calculation, while the credit trims the final number after it's grown. Both are valuable, but they work at different stages. Standard deduction. Almost everyone has the option to take what's called the standard deduction. This is a fixed amount that the government allows you to subtract from your income automatically, without having to prove specific expenses. The amount changes depending on your filing status, whether you are single, married filing jointly, or head of household. The standard deduction is generous for many people, and often the best choice if you don't have large, specific expenses to list. For example, imagine a person who works one job, rents an apartment, and doesn't own a business. They might not have many special expenses to claim. By taking the standard deduction, they simplify their return while still lowering the amount of income that gets taxed. Itemized deductions. The other option is called itemizing. This means you list out specific expenses from the year that the government allows you to subtract. Some common itemized deductions include mortgage interest, if you own a home, state and local taxes paid, charitable donations, if you gave money or goods to qualified organizations, medical expenses that were especially high compared to your income. Itemizing requires more paperwork, but for some people, it reduces their taxable income more than the standard deduction would. That's why many tax filers take a moment to compare. They ask, which one saves me more? The system is flexible. You can choose the one that works best for your situation. Common tax credits. Now let's talk about credits. There are many types, but we'll focus on some of the most common. One of the most well-known is the child tax credit. If you have children under a certain age, you may qualify for a credit that directly reduces your taxes. The goal is to help families with the costs of raising children. Another credit is the Earned Income Tax Credit, often called the EITC. This one is designed for people who work and earn income, but whose earnings fall within a lower range. It can provide a significant refund. and in some cases, it may mean receiving money back even if you didn't owe much in the first place. There are also credits for education, such as the American Opportunity Credit or the Lifetime Learning Credit. These reward people who are paying for higher education, whether it's tuition, books, or other qualifying expenses. And there are credits for energy-efficient improvements to your home, for adoption expenses, and for retirement savings contributions. Each one has its own rules, but the pattern is the same. A credit directly reduces your tax bill, dollar for dollar. How to decide what applies to you. So, how do you know which deductions and credits apply to you? The answer begins with awareness. As you live your year, you might not think of every expense as a potential tax benefit. But when tax season arrives, it helps to pause and review. Did you pay for school? Did you pay interest on a mortgage? Did you donate to a recognized charity? Did you make improvements to your home that save energy? Did you raise a child? Each of these may open the door to a deduction or credit. If you're using software, it will usually ask you guided questions. If you're working with a professional, they will likely walk you through a checklist. Your task now, as the learner, is to become familiar with the categories so you feel confident recognizing them. Why the last step matters. Deductions and credits are the system's way of recognizing that people's lives are different. Not everyone spends their money in the same way. Not everyone has the same responsibilities. By allowing deductions and credits, the tax system adjusts itself slightly to fit the shape of your life. Imagine two people who both earn $50,000. One has no children, rents an apartment, and takes the standard deduction. The other has 2 children, owns a home, pays mortgage interest, and qualifies for child-related credits. Both earn the same amount, but the tax bills will look very different. This isn't a mistake. It's the system working as designed, accounting for real differences. In life situations, a calm exercise. Now picture yourself again at your desk with your folder next to your pile of income documents. Imagine a second pile of receipts and papers. Maybe there's a receipt from a charity donation. Maybe there's a statement from your student loan. Maybe there's a document showing mortgage interest paid. As you look at each one, you ask yourself, is this something that can reduce my taxes? If it feels overwhelming, remember that you don't need to memorize every possible deduction or credit right now. Instead, focus on the big categories: living situation, family, education, health, and charitable giving. These are the areas where deductions and credits often appear. Closing thoughts on deductions and credits. At this stage, you've learned the difference between deductions and credits. You understand the choice between taking the standard deduction or itemizing. You recognize some of the most common credits available. Most importantly, you know that these tools are here to help you. Taxes are not only about what you owe, they're also about what you can keep. Deductions and credits balance the system and remind you that the story of your year is more than just the money you earned. It's also about the responsibilities you carried, the choices you made, and the support you gave or received. So tonight, let your mind rest easy, knowing that this step is not about taking something away from you, but about giving something back. You've built a foundation with income, and now you've softened the soil with deductions and credits. In the next section, we'll begin to see how these pieces come together in the form you actually file, the tax return itself. Now that you understand deductions and credits, let's pause and look at something that seems small, but has a huge effect on your taxes: your filing status. This is one of the first choices you make when filling out your return, and it influences almost every number that follows. It determines your standard deduction amount, your tax brackets, and which credits you qualify for. Think of filing status as the lens through which the government views your financial year. If the wrong lens is chosen, the picture becomes distorted. But with the right one, the image is clear, and the tax calculation reflects your true situation. The main filing statuses. There are 5 main filing statuses. Each one is designed for a different life situation. Single. This is the simplest and most straightforward. If you are unmarried, divorced, or legally separated on the last day of the year, you generally file as single. It's the default option for many people, especially younger workers or those not in a legal marriage. Married filing jointly. If you're married, you and your spouse can combine your incomes and deductions into one return. Filing jointly often results in a lower total tax bill compared to filing separately. It also opens up certain credits and benefits that are not available otherwise. Many couples choose this route for the simplicity and financial advantage. Married filing separately. This option is available but less common. Each spouse files their own return, reporting only their own income and deductions. It sometimes makes sense in special situations, like when one spouse has very high medical expenses or liability concerns. However, it can reduce eligibility for certain credits. Head of household. This one applies if you are unmarried, but you also provide a home for a qualifying dependent, such as a child or another family member. Head of household offers a higher standard deduction than filing single, and often lower. Tax brackets. It recognizes the added responsibility of supporting others. Qualifying widow or widower with dependent child. This is special status is available for up to 2 years after a spouse has died, as long as you have a dependent child. It allows you to use the same tax rates as married filing jointly, providing financial relief during a difficult time. Why filing status matters. Filing status affects your tax return in 3 major ways. Standard deduction. The amount you can subtract automatically from your income is different depending on your status. For example, married couples filing jointly receive a much larger standard deduction than someone filing single. Tax brackets. The percentage of tax you pay at different income levels shifts depending on your filing status. For example, a head of household filer may pay less tax at the same income level than a single filer. Eligibility. For credits and deductions, some tax benefits are only available if you file under a specific status. For example, certain education or child-related credits may not apply if you file as married filing separately. Examples to make it clear. Imagine 3 people, each earning $60,000. The first is single. They take the standard deduction for single filers. Their taxable income and tax owed reflect only their own situation. The second is married with a spouse who earns no income. By filing jointly, their standard deduction is almost doubled, and their tax brackets are more favorable. The third is unmarried, but raising a child. By filing as head of household, their standard deduction is larger than a single filer's, and their brackets give them a lower tax bill. Each person earned the same income, but their filing status changes the story completely. That's why this choice matters so much, choosing the right status. For many people, the choice is simple. If you're single, you file as single. If you're married, you usually file jointly, but sometimes the decision requires thought. For example, a married couple might ask, should we file jointly or separately? The answer depends on their unique circumstances. Filing separately can sometimes reduce liability if one spouse owes certain debts, or if combining incomes pushes them into a higher bracket. On the other hand, filing jointly usually provides more tax benefits. For someone raising a child, the question is whether they qualify as head of household. The key requirement is that you paid more than half the cost of maintaining the home, and that the child lived with you for more than half the year. Meeting these conditions unlocks valuable tax advantages. A calm exercise. Picture yourself at your desk again, with your folder open. On one sheet of paper, you write down your living situation. Are you single? Married? Do you support a child or another family member? On another sheet, you list the requirements for each filing status. Then, like matching puzzle pieces, you place them side by side until the fit is clear. This isn't about guessing. It's about carefully aligning your real life with the category that best describes it. The system is flexible enough to recognize different situations, but it relies on you to choose the right lens. The emotional side filing status is not only a financial decision, it's also a reflection of your personal life. It asks, who are you supporting? What commitments define your year? Are you navigating life alone? Or are you carrying others with you? This step quietly acknowledges that taxes are not just numbers. They are connected to family, responsibility, and even grief. For example, someone who has lost a spouse but still cares for a child is given extra time to transition financially. Someone raising children alone is recognized for the burden they carry. Filing status is the system's way of saying, your circumstances matter. Closing thoughts on filing status. At this stage, you've learned about the 5 main filing statuses: single, married filing jointly, married filing separately, head of household, and qualifying widow or widower with a dependent child. You know why they matter, how they affect your tax return, and how to decide which one fits your life. This choice is not something to rush. It's the frame that holds the picture of your tax return. With the right frame, the image is accurate and fair. With the wrong one, the numbers may not reflect your reality. So, as you prepare, take a quiet moment to reflect on your life situation. Write it down, compare it with the definitions, and choose carefully. Once you have your filing status, the rest of your tax journey will have a clear path forward. In the next section, we'll begin bringing everything together by looking at how income, deductions, credits, and filing status all flow into the actual tax form itself. Up until now, we've talked about pieces of the puzzle: income, deductions, credits, and filing status. But where do all of these details actually come together? The answer is the tax form. For many people, the tax form feels intimidating. Rows of numbers, strange boxes, and unfamiliar lines can create stress before you even begin. But here's the truth. The form is just a map. It's a structured way to tell your financial story for the year. If you can read the map step by step, the path becomes clear, and you'll see how each part connects to what you've already learned. The main form, Form 1040. The form most individual taxpayers use is called the Form 1040. This is the backbone of your tax return. Think of it as a summary document. It doesn't show every detail, but it pulls all the threads together: income, deductions, credits, and taxes owed. Form 1040 is only 2 pages long in its main version, though you may attach additional schedules. Don't let its size fool you. Those 2 pages contain all the essential numbers that the IRS needs to calculate your taxes. Breaking down the form, Let's walk through the main sections of Form 1040, slowly and carefully. Picture the form in front of you, each part flowing into the next. Personal information. At the very top, the form asks for your name, address, social security number, and filing status. This is simple, but crucial. It identifies who you are and how you'll be taxed. You'll also list dependents here, such as children or other qualifying family members. Income section. The next part is where you report your income. It includes wages from jobs, business income if you're self-employed, interest from bank accounts, dividends from investments, and any other sources. This section answers the question, how much money did you bring in during the year? You don't write everything manually from scratch. Most income sources give you forms, like a W-2 from your employer, or a 1099 if you did freelance work. These documents show your income and taxes already withheld. Adjustments to income. After listing your total income, the form allows for adjustments. These are specific deductions that come before the standard deduction or itemized deductions. For example, contributions to certain retirement accounts or student loan interest may appear here. This step creates your adjusted gross income, AGI, a key number used in many parts of the tax system. Deductions. Here, you choose between the standard deduction and itemized deductions. As we discussed earlier, the standard deduction is a flat amount based on your filing status, while itemizing allows you to list expenses like mortgage interest, medical costs, or charitable giving. The choice you make here significantly reduces your taxable income. Tax and credits. Once your taxable income is calculated, the form applies the tax rates. This is where brackets come into play. Then, you subtract credits you qualify for, such as the child tax credit or education credits. These reduce your tax bill directly, line by line. Other taxes. Some people may need to add additional taxes, like self-employment tax or taxes on retirement account distributions. Not everyone will use this section, but it's there for those special cases. Payments. The form also records what you've already paid through the year. If your employer withheld taxes from your paycheck, those amounts show up here. If you made estimated tax payments, they're included too. Refund or amount owed. Finally, the bottom of the form delivers the answer most people wait for. Do you get a refund or do you owe money? This is the result of all the steps above. If you paid more than you owe, you'll see a refund. If you paid less, you'll owe the difference. Why? Understanding the form matters. Even if you use tax software, it's valuable to know how the form works. Software may guide you through questions, but behind the scenes, it's filling in Form 1040. By understanding its flow, you know where your numbers come from and why the final result is what it is. When you can read the form yourself, you avoid the fear of mystery numbers. Each line connects to something you've already learned. Income, deductions, credits, and payments. The form simply organizes them into a single story. A mental walkthrough. Imagine sitting at your desk again, with your papers neatly organized. First, you reach for your W-2. You see your total wages, and you copy them onto the income section of the 1040. Then, you find a 1099 from your savings account, showing a small amount of interest. That number joins the first. Next, you glance at your student loan statements. You enter the interest you paid as an adjustment to income. You notice how your adjusted gross income drops slightly. This shows the effect of that deduction. Now, you choose your standard deduction. The taxable income number falls again. You apply credits for education, reducing your tax bill directly. Then, you look at the taxes already withheld from your paychecks. The amount is larger than what you owe, so the bottom line shows a refund. As you read through the form, you realize there's no mystery. It's simply numbers flowing in order, from income to final result. The emotional shift at first. Many people feel tension when they see the tax form, but as you understand its flow, the form becomes less of a threat and more of a mirror. It reflects your financial year back to you. It doesn't invent numbers. It just records them. This shift in perspective is powerful. Instead of fearing the form, you can use it as a tool. It shows where your money came from, where it went, and how the system views it. In a way, it's a summary of your year written in numbers. Closing thoughts on the tax form 1040 may look dense at first, but you now know how to read it. You've seen the main sections: personal information, income, adjustments, deductions, tax and credits, other taxes, payments, and the final refund or amount owed. Each part flows logically into the next. This form is not designed to confuse you. It's designed to capture your year in a structured way. When you read it slowly, with patience, it becomes a map. And with any map, once you learn the symbols, you can navigate confidently. In the next section, we'll go deeper into common mistakes and pitfalls, the errors that trip people up and how to avoid them. Understanding these mistakes will save you stress and help you file smoothly. Up until now, we've talked about pieces of the puzzle: income, deductions, credits, and filing status. But where do all of these details actually come together? The answer is the tax form. For many people, the tax form feels intimidating. Rows of numbers, strange boxes, and unfamiliar lines can create stress before you even begin. But here's the truth. The form is just a map. It's a structured way to tell your financial story for the year. If you can read the map step by step, the path becomes clear, and you'll see how each part connects to what you've already learned. The main form, Form 1040. The form most individual taxpayers use is called the Form 1040. This is the backbone of your tax return. Think of it as a summary document. It doesn't show every detail, but it pulls all the threads together. Income, deductions, credits, and taxes owed. Form 1040 is only 2 pages long in its main version, though you may attach additional schedules. Don't let its size fool you. Those 2 pages contain all the essential numbers that the IRS needs to calculate your taxes. Breaking down the form, let's walk through the main sections of Form 1040, slowly and carefully. Picture the form in front of you, each part flowing into the next. Personal information. At the very top, the form asks for your name, address, social security number, and filing status. This is simple, but crucial. It identifies who you are and how you'll be taxed. You'll also list dependents here, such as children or other qualifying family members. Income section. The next part is where you report your income. It includes wages from jobs, business income if you're self-employed, interest from bank accounts, dividends from investments, and any other sources. This section answers the question, how much money did you bring in during the year? You don't write everything manually from scratch. Most income sources give you forms, like a W-2 from your employer, or a 1099 if you did freelance work. These documents show your income and taxes already withheld. Adjustments to income. After listing your total income, the form allows for adjustments. These are specific deductions that come before the standard deduction or itemized deductions. For example, contributions to certain retirement accounts or student loan interest may appear here. This step creates your adjusted gross income, AGI, a key number used in many parts of the tax system. Deductions. Here, you choose between the standard deduction and itemized deductions. As we discussed earlier, the standard deduction is a flat amount based on your filing status, while itemizing allows you to list expenses like mortgage interest, medical costs, or charitable giving. The choice you make here significantly reduces your taxable income. Tax and credits. Once your taxable income is calculated, the form applies the tax rates. This is where brackets come into play. Then, you subtract credits you qualify for, such as the child tax credit or education credits. These reduce your tax bill directly, line by line. Other taxes. Some people may need to add additional taxes, like self-employment tax, or taxes on retirement account distributions. Not everyone will use this section, but it's there for those special cases. Payments. The form also records what you've already paid through the year. If your employer withheld taxes from your paycheck, those amounts show up here. If you made estimated tax payments, they're included too. Refund, or amount owed. Finally, the bottom of the form delivers the answer most people wait for. Do you get a refund, or do you owe money? This is the result of all the steps above. If you paid more than you owe, you'll see a refund. If you paid less, you'll owe the difference. Why? Understanding the form matters. Even if you use tax software, it's valuable to know how the form works. Software may guide you through questions, but behind the scenes, it's filling in Form 1040. By understanding its flow, you know where your numbers come from, and why the final result is what it is. When you can read the form yourself, you avoid the fear of mystery numbers. Each line connects to something you've already learned. Income, deductions, credits, and payments. The form simply organizes them into a single story. A mental walkthrough. Imagine sitting at your desk again, with your papers neatly organized. First, you reach for your W-2. You see your total wages, and you copy them onto the income section of the 1040. Then, you find a 1099 from your savings account, showing a small amount of interest. That number joins the first. Next, you glance at your student loan statements. You enter the interest you paid as an adjustment to income. You notice how your adjusted gross income drops slightly. This shows the effect of that deduction. Now, you choose your standard deduction. The taxable income number falls again. You apply credits for education, reducing your tax bill directly. Then, you look at the taxes already withheld from your paychecks. The amount is larger than what you owe, so the bottom line shows a refund. As you read through the form, you realize there's no mystery. It's simply numbers flowing in order, from income to final result. The emotional shift at first. Many people feel tension when they see the tax form, but as you understand its flow, the form becomes less of a threat and more of a mirror. It reflects your financial year back to you. It doesn't invent numbers. It just records them. This shift in perspective is powerful. Instead of fearing the form, you can use it as a tool. It shows where your money came from, where it went, and how the system views it. In a way, it's a summary of your year written in numbers. Closing thoughts on the tax form 1040 may look dense at first, but you now know how to read it. You've seen the main sections: personal information, income, adjustments, deductions, tax and credits, other taxes, payments, and the final refund or amount owed. Each part flows logically into the next. This form is not designed to confuse you. It's designed to capture your year in a structured way. When you read it slowly, with patience, it becomes a map. And with any map, once you learn the symbols, you can navigate confidently. In the next section, we'll go deeper into common mistakes and pitfalls, the errors that trip people up and how to avoid them. Understanding these mistakes will save you stress and help you file smoothly. Even with all the preparation and knowledge in the world, mistakes can still happen when filing taxes. And that's completely normal. The important part is knowing what the most common pitfalls are, why they happen, and how you can avoid them. When you're aware of them, you'll be able to catch problems before they cause stress. Think of this section as a guidebook of red flags. By the end, you'll be able to recognize these issues and file with much more confidence. Mistake 1. Entering incorrect personal information. It sounds simple, but one of the most common errors people make is putting down the wrong social security number, name, or bank account information. Even something as small as a misspelled name can delay your refund for weeks. Imagine spending hours preparing everything, only to realize that one wrong digit kept the IRS from matching your return to your account. This mistake usually happens when people rush. To avoid it, take a slow moment at the start. Double-check your name matches your social security card exactly. Review every digit of your number. If you're entering a bank account for direct deposit, read it aloud, digit by digit, before finalizing. A simple pause here can save weeks of waiting. Mistake 2. Forgetting to report all income. Another frequent issue is forgetting to report all income sources. Many people remember their main job, but forget about smaller sources like freelance gigs, side jobs, or even the small interest from a savings account. Here's what often happens. You get a form in the mail, like a 1099 for a short freelance job, but you set it aside because the amount feels small. Later, when filing, you only include your main W-2 job. The IRS, however, receives copies of all those forms, big or small. When they notice something missing, they'll send you a notice. The best way to avoid this is to create a checklist of all possible income sources before you start. Think about every way money came into your life last year, even if it was just $20 of bank interest. By gathering every form, W-2s, 1099s, interest statements, you'll have the full picture. Mistake 3. Mixing up credits and deductions. Many people confuse credits with deductions. A deduction reduces your taxable income, while a credit reduces the tax you owe directly. For example, if you're eligible for the child tax credit, that's a dollar-for-dollar reduction of your bill. If you're taking the standard deduction, that reduces the income the government taxes. The pitfall happens when people assume a deduction will reduce their tax owed by the same amount. In reality, a $1,000 deduction only lowers your taxable income by $1,000, not your tax bill. But a $1,000 credit lowers your bill by the full $1,000. To avoid confusion, remember this simple phrase: deductions shrink your income, credits shrink your tax. Mistake 4. Filing under the wrong status. Your filing status: single, married filing, jointly, married, filing separately, head of household, or qualifying widower has a huge impact on your taxes. Yet, many people choose the wrong one. For example, some married couples file separately because they think it will save them money. In reality, filing jointly usually leads to a better outcome because you qualify for more credits together. Others forget they may qualify as head of household if they support dependents, which gives them a larger standard deduction. The key is to review the definitions of each status carefully. Ask yourself, who do I support, and what is my household situation? Choosing the right status ensures you get the deductions and credits you deserve. Mistake 5. Forgetting to sign the return. This one is shockingly common. An unsigned tax return is like an unsigned check. It's not valid, whether you're filing on paper or electronically. A missing signature delays everything. If you're filing electronically, your software will usually prompt you to enter a PIN as a digital signature. If you're mailing a paper return, make sure you sign and date it at the end. It only takes a few seconds, but missing it can stall your refund completely. Mistake 6. Overlooking direct deposit. Many people still choose to get refunds by check, but paper checks can get lost or delayed. Direct deposit is faster, safer, and usually arrives in your bank account in less than 3 weeks. The mistake comes when people don't set it up, or they enter the wrong bank numbers. If you want the quickest refund possible, double-check your account and routing numbers and select direct deposit. It's a small step with a big impact. Mistake 7. Waiting until the last minute. Filing at the deadline is stressful, and it's a recipe for mistakes. Rushing often leads to missing forms, math errors, or forgetting credits you qualify for. Even if you manage to submit on time, you'll likely feel anxious the entire process. Instead, set a personal deadline, a few weeks before the IRS deadline. That way, if something is missing, like a form that got lost in the mail, you'll still have time to fix it. Filing early also gets you a faster refund if you're due one. Mistake 8. Not keeping copies. Once people file, they often forget to keep a copy of their return. Months later, if they need it for financial aid, a loan, or even just for their own records, they realize they don't have it. Keeping a copy of your return is important. It helps you prepare for the next year too, since you can see your previous income, deductions, and credits. Whether you store it digitally or in a physical folder, make sure you can access it when needed. Mistake 9. Misunderstanding, withholding. Some people assume that if they get a refund, it means they did their taxes right. In reality, a refund simply means you paid more than you owed during the year. On the flip side, if you owe money, it doesn't mean you did something wrong. It just means less tax was withheld from your paychecks. The pitfall is not adjusting withholding when your life changes. For example, if you get married, have a child, or switch jobs, you may need to update your W-4 with your employer. If you don't, you might end up with a big bill at tax time. Mistake 10. Ignoring IRS notices. Sometimes, the IRS sends a notice about a missing form or a math adjustment. Many people panic and ignore it, but most of the time, these notices are simple and can be resolved quickly. The best approach is to read the notice calmly, compare it to your return, and respond if needed. Ignoring it only makes the problem worse. The emotional side of mistakes. It's easy to feel discouraged when you hear about all the ways things can go wrong. But here's the truth. Most mistakes are simple and easy to avoid with a bit of attention. They don't mean you're bad with money or irresponsible. They just mean you're human. When you slow down, double-check your numbers, and stay organized, you'll avoid the majority of pitfalls. And even if you do make a mistake, it's usually fixable. Amended returns exist for a reason. Closing thoughts on pitfalls. The most common mistakes aren't complicated. They're small, everyday oversights. Wrong numbers, missing income, unsigned forms, and late filing. But now, you know what to watch for. You can approach your taxes with calm, steady confidence, checking each step along the way. In the next section, we'll talk about tools and resources that make the process easier. Software, IRS resources, and professional help. These tools, combined with the knowledge you now have, will give you even more confidence to handle taxes smoothly. Filing your taxes doesn't have to feel like wandering through a maze. In fact, one of the biggest differences between a stressful tax season and a smooth one often comes down to the tools you use. Think of this section as a map. Instead of trying to carry the weight of every detail yourself, you'll learn about resources designed to guide you, double-check your work, and even handle most of the heavy lifting for you. Let's walk through the most helpful tools, from digital software to free IRS programs, and even professional assistance. By the end of this section, you'll have a clear list of options to lean on, no matter your level of experience or comfort with taxes. Tax preparation. Software. One of the most popular resources today is tax preparation software. Programs like TurboTax, H&R Block Online, or TaxAct are built for people who want a guided, step-by-step experience. When you use one of these programs, you don't just stare at blank forms. Instead, the software asks you questions in plain language. Things like, did you earn income from self-employment? Or did you pay for childcare last year? Based on your answers, the program fills out the right forms behind the scenes. The biggest advantages are user-friendly guidance. No need to memorize tax codes or line numbers. The software translates the rules into everyday language. Error checking. Many programs automatically check for common mistakes and warn you before you submit. E-filing and direct deposit. Most software lets you file electronically and set up direct deposit for a faster refund. If you want peace of mind without learning every IRS form by heart, tax software is one of the best tools to use. Free IRS programs, nchut. Everyone realizes this, but the IRS itself offers free tools to help you. The main one is called IRS Free File. If your income falls below a certain limit, you can use brand name tax software for free through this program. There's also Free File Fillable Forms, which is basically an online version of the paper forms. This option is best if you're comfortable doing the math yourself, but still want the convenience of e-filing. In addition, the IRS website has an enormous library of resources. You can find publications that explain every deduction and credit, tools to track your refund, and even a withholding calculator to help you set up your paychecks correctly for the next year. The key here is that the IRS doesn't just collect taxes, they also provide tools to help you stay accurate. Professional tax preparers. Sometimes software or free tools aren't enough. Maybe your taxes are complicated. Maybe you run a small business, invest heavily in stocks, or own rental property. In cases like this, hiring a professional can save you time and stress. There are a few types of professionals. Certified public accountants, CPAs. These are licensed experts who can handle complex situations, give advice, and represent you if the IRS has questions. Enrolled agents, EAs. These are federally licensed tax experts who specialize in tax law and can also represent you before the IRS. Tax preparers at chains. Companies like H&R Block or Liberty Tax offer in-person services where a preparer will handle your return for a fee. The advantage of professionals is their knowledge. They can spot deductions you didn't know about and ensure everything is accurate. The drawback, of course, is the cost. But if your situation is complex, the savings and peace of mind often outweigh the expense. Volunteer income, tax assistance. VITA, if you're looking for in-person help but don't want to pay, the VITA program is a great option. VITA stands for Volunteer Income Tax Assistance. It's run by the IRS, but staffed by trained volunteers. These volunteers help people who generally make less than $60,000 a year, have disabilities, or speak limited English. They'll walk you through your return for free and help you file it. There's also a similar program called TCE, Tax Counseling for the Elderly, which specializes in helping older adults with things like retirement income and Social Security benefits. For many people, VITA and TCE are hidden gems. They provide high-quality help without the price tag of hiring a private preparer. Financial apps and tools beyond filing software. There are apps that help you prepare for tax season throughout the year. Tools like Mint, YNAB, You Need a Budget, or QuickBooks help track your income and expenses automatically. If you're self-employed, these apps can separate business and personal expenses, store receipts, and even estimate quarterly taxes. By the time tax season arrives, all the information you need is already organized. For employees, these apps can give you a clearer picture of your finances, which makes it easier to plan deductions and see how much you've paid in withholding. IRS Helpline and Online Accountant may not be as flashy as an app, but the IRS itself provides direct assistance. You can call their helpline for answers to general tax questions. More recently, the IRS has expanded its online account system, which lets you view past returns, track your payments, and see how much you owe or what refunds you're due. This online account can be extremely helpful if you're trying to understand your history with taxes or need to quickly check your standing before filing. Record-keeping systems. One often overlooked tool is simply an organized filing system. Whether it's digital folders on your computer or a physical binder, having a system for storing tax documents saves enormous amounts of time. Think about categories like income documents, W-2s, 1099s, bank statements, deduction records, receipts, donations, medical bills, credit documentation, childcare costs, education expenses, prior year returns. When everything has a place, filing becomes smoother and less stressful. A small investment in organization today can prevent big headaches tomorrow. Deciding which tools to use. You might be wondering, which option is best for me? The truth is, it depends on your situation. If your taxes are simple, free file, or basic tax software may be enough. If your taxes are moderately complex, paid software with live support might give you balance between cost and convenience. If your taxes are very complex, a CPA or enrolled agent is likely your best bet. If you qualify for free assistance, VITA or TCE can give you professional quality help at no cost. The important thing is to know that you don't have to do this alone. The right tool can make filing smooth and stress-free. Closing thoughts on tools. Taxes can feel intimidating, but they don't have to be. Whether it's software that translates tax law into simple questions, free IRS programs that guide you step by step, or trained professionals who handle the process for you, there are countless resources available. When you combine the right tools with the knowledge you've gained so far, filing becomes less about stress and more about checking off steps with confidence. In the next section, we'll go even further, talking about how to plan ahead for next year, so that tax season stops being something you dread and instead becomes a natural part of your financial rhythm. Now that you understand the steps of filing taxes and the tools you can use, let's shift our focus forward, because here's the truth. Taxes aren't just something that happen once a year. They're the result of choices you make throughout the year. What you earn, how you spend, how you save, and even how you keep records. When you prepare for tax season in advance, you take control of the process. Instead of scrambling in April with receipts scattered across your desk, you move through the year with a system. By the time tax season arrives, your information is organized, your deductions are clear, and you know exactly what to expect. This section is all about giving you that kind of control. Let's break it down into steps you can start applying right away. Step 1. Understand your withholding. For most employees, taxes are paid throughout the year through withholding. Your employer automatically takes money from your paycheck and sends it to the IRS. The key is making sure that withholding is accurate. If too little is withheld, you could owe a large amount when you file. If too much is withheld, you'll get a refund. But that means you've essentially given the government an interest-free loan. To get this balance right, the IRS offers a withholding estimator on their website. It's a simple tool where you enter your income and family situation. The estimator then tells you if your current withholding matches your needs, or if you should adjust your W-4 form with your employer. Checking this once a year, especially if your job, family size, or income changes, can prevent surprises during tax season. Step 2. Track income year-round. If you have just one job and a W-2, your employer keeps track for you. But if you have side income, like freelancing, gig work, rental income, or investments, you'll want to record this as it comes in. A simple spreadsheet, or even a budgeting app works well for this. The goal is to avoid the situation where you're trying to remember every dollar you earned at the last minute. For self-employed workers, this step is especially important. Not only will you need to know your income, but you'll also need to pay quarterly estimated taxes. Tracking as you go ensures you're not caught off guard. Step 3. Save receipts for deductions. Many deductions require proof. Did you donate to charity? Keep the receipt. Did you pay for medical care? Save the bill. Did you buy supplies for a small business? Keep the invoices. One of the easiest ways to stay organized is to create a dedicated folder for receipts, digital or physical. Some people take photos of receipts and upload them into cloud storage, where they're safe and searchable. Others prefer a binder or envelope system. It doesn't matter which method you choose. What matters is consistency. If you build the habit of saving proof as you go, you'll have everything ready when it's time to file. Step 4. Consider retirement. Contributions. One of the best ways to reduce your taxable income is by contributing to retirement accounts. Options like a 401k or traditional IRA allow you to put away money for the future while lowering your tax bill today. For example, if you earn $50,000 a year and contribute $5,000 to your 401k, the IRS only taxes you on $45,000. You save for retirement while lowering your taxes at the same time. If your employer offers a match on 401k contributions, that's even better. Not only do you reduce taxes, but you also gain free money toward your retirement savings. Step 5. Plan for major life events. Life changes affect taxes. Getting married, having a child, buying a house, or starting a business can all shift your tax situation. Planning ahead means understanding how these changes will affect you. For example, marriage. You may choose between filing jointly or separately. Children. You could qualify for credits like the child tax credit or dependent care credit. Buying a home. You may be able to deduct mortgage interest and property taxes. Starting a business, you'll likely qualify for deductions on business expenses, but you may also owe self-employment tax. When you know these things ahead of time, you can prepare documents and adjust your finances before tax season arrives. Step 6. Review your credits. Credits are powerful because they reduce your tax bill directly, dollar for dollar. Some common credits include Earned Income Tax Credit, EITC, for low to moderate income earners, Child Tax Credit, for parents of qualifying children, Education Credits, for students or parents paying tuition. Review these each year to see if you qualify. Planning ahead might even influence decisions you make, like paying tuition this year instead of next, or adjusting childcare costs to maximize credits. Step 7. Make quarterly adjustments if needed. If you're self-employed or earn money outside of a regular paycheck, you may need to make quarterly estimated payments. These payments keep you on track with the IRS and prevent penalties for underpayment. Even if you're not self-employed, quarterly check-ins are a smart practice. Every few months, sit down and look at your income, withholding, and deductions. Ask yourself, am I on track? Do I need to adjust anything? This habit turns tax season from a once-a-year scramble into a predictable routine. Step 8. Keep last year's return. Handy one. Simple but often overlooked. Strategy is keeping a copy of your last return nearby. It serves as a roadmap. Looking at it reminds you of what forms you needed, which deductions you claimed, and what mistakes to avoid. When you prepare for next year, start by reviewing last year. It helps you stay consistent and prevents you from forgetting important details. Step 9. Build a tax calendar. Deadlines matter. Missing one can lead to penalties. To avoid this, create a tax calendar. Mark important dates, such as January, W-2s and 1099s should arrive. April, standard filing deadline. June, September, January, quarterly payments due. October, extension deadline, if you filed one. Having these dates in your phone or planner means you'll never be surprised by a deadline. Step 10. Mindset. Shift, finally. One of the most powerful ways to plan ahead is changing how you think about taxes. Instead of dreading them, view taxes as part of your financial story. They reflect your income, your family, your savings, and even your goals. When you see taxes in this light, preparation feels less like a burden and more like a chance to take control. Closing thoughts on planning ahead. Planning ahead is about reducing stress and increasing confidence. When you adjust your withholding, track income, save receipts, and understand deductions, you take small steps that add up to big peace of mind. Instead of taxes being a once-a-year storm, they become a process you manage with intention. By applying the steps in this section, next year's filing will feel less like a surprise and more like something you're ready for, and that's the ultimate goal. Not just surviving tax season, but mastering it. Many people breathe a sigh of relief when they file their taxes and discover they're getting a refund. But what if the opposite happens? What if you file your return and realize you owe money? It can feel stressful, even overwhelming. You might worry about how you'll pay, or what will happen if you can't. The good news is, you have options. Owing taxes is common, and the IRS has clear systems in place to help people handle it. Let's walk through what you should do if you find yourself in this situation. Step 1. Stay calm and confirm the amount first. Don't panic. Millions of taxpayers owe money each year. It doesn't mean you did something wrong. It just means your withholding or estimated payments didn't fully cover your tax liability. Start by carefully reviewing your return. Double-check your income, deductions, and credits. Did you enter everything correctly? Did you include all the forms you received? Sometimes a simple typo or missed credit can change your balance if the numbers are correct, except that this is the amount due. Knowing the exact figure is the first step to planning how to handle it. Step 2. File your return on time. Anyway, this part is critical. Even if you can't pay the full balance immediately, always file your return on time. Filing late adds extra penalties on top of what you owe. The IRS charges 2 types of penalties: a failure to file penalty for not submitting your return by the deadline, a failure to pay penalty for not paying what you owe. Of the two, the failure to file penalty is much larger, so file your return by the deadline, even if you can only make a partial payment. Step 3. Pay what you can, right away. If you owe money, the best thing you can do is pay as much as you can by the due date, even if you can't cover the full amount. Paying part of it reduces interest and penalties. For example, if you owe $2,000 but can only pay $800 now, send the $800. That $800 won't rack up interest or penalties. You'll only be charged on the remaining $100. You can pay online through the IRS's official website, which accepts bank transfers, debit cards, and even credit cards. Step 4. Consider your payment options. If you can't pay the full balance, the IRS offers payment plans. Here are the main types. Short-term payment plan for balances under $100,000 gives you up to 180 days to pay. No setup fee, but you'll still pay interest and penalties until the balance is cleared. Long-term payment plan, installment agreement, for balances under $50,000, lets you make monthly payments for up to 72 months, 6 years. There's a setup fee, but you can choose automatic payments from your bank account. Offer and compromise rare, but possible. If paying in full would cause extreme financial hardship, you can apply to settle your debt for less than the total owed. The IRS reviews your income, expenses, and ability to pay before deciding. Currently, not collectible status. If you truly cannot afford to pay anything right now, you can request to be placed in currently not collectible status. This temporarily pauses collection efforts. Interest still accrues, but the IRS will not demand payment until your situation improves. Step 5. Weigh the costs of borrowing. If you don't qualify for an IRS payment plan, or if you want to avoid long-term penalties, you might consider borrowing money elsewhere to pay your taxes. For example, a personal loan may have lower interest rates than IRS penalties. A credit card can work, but watch out for high interest. Sometimes, though, the one-time IRS late penalty may be higher than your card's short-term interest. The right option depends on your situation. Run the numbers before deciding. Step 6. Adjust for next year. Owing taxes can be a wake-up call. Maybe your employer didn't withhold enough, or you underestimated your quarterly payments. To avoid repeating the problem next year, take action now. If you're employed, adjust your Form W-4 with your employer. You can increase your withholding, so more money is taken from each paycheck. If you're self-employed, adjust your quarterly estimated payments. Pay a little more each quarter to prevent a big bill at tax time. Think of this year's experience as a lesson for smoother sailing in the future. Step 7. Don't ignore the debt. The worst thing you can do is pretend it doesn't exist. If you ignore a tax bill, interest and penalties will continue to grow. Eventually, the IRS can place liens on your property, garnish wages, or seize assets, but as long as you communicate with them and set up a payment plan, the IRS is generally cooperative. They would rather receive steady payments than take drastic measures. Step 8. Keep records of all payments. Whenever you make a payment, whether online, by mail, or through a plan, keep a record. Save confirmation numbers, copies of checks or bank statements. This way, if there's ever a question, you can prove you made the payment. Step 9. Seek professional advice. If needed, if the amount you owe is large, or if you're overwhelmed by the options, consider speaking with a tax professional. They can help negotiate with the IRS, explain the best payment plan, or even help you apply for an offer in compromise. Sometimes, having an expert in your corner takes away a lot of stress. Final thoughts on owing taxes. Owing money to the IRS is not the end of the world. It doesn't mean you failed. It simply means your tax situation turned out differently this year. The key is to face it directly. Use the options available and create a plan that works for you. Remember, the IRS doesn't want to ruin your life. They want you to pay what you owe, but they understand that people sometimes need time or flexibility. By filing on time, paying what you can, and using tools like installment plans, you can take control of the situation. In the long run, handling owed taxes responsibly builds your financial confidence. You'll know that even in tough situations, you can face them calmly, make smart choices, and move forward. For many people, tax season brings a sense of relief because it ends with a refund. Seeing money flow back into your account after filing can feel like a reward for making it through the paperwork. But have you ever wondered why refunds happen? How long they take? Or what you should do if yours seems delayed? Let's break it down step by step so you fully understand tax refunds and what to expect. Why refunds happen at a refund doesn't mean the government is giving you free money. It simply means you paid more than you owed during the year. This usually happens in one of two ways. Too much withholding. If you're an employee, your employer withholds taxes from every paycheck. If they withheld more than your actual tax liability, you'll get the difference back as a refund. Overpayment through estimated taxes. If you're self-employed or pay quarterly taxes, you might have sent in more than necessary. That extra comes back as a refund. Think of it as a year-long interest-free loan you gave to the government. You're just getting your own money back. Step 1. How refunds are calculated. When you file your tax return, the IRS compares your total, tax owed, after credits and deductions, with the total you already paid, through withholding or estimated payments. If the payments are higher than the tax owed, the difference is your refund. For example, you owed $4,800 in taxes for the year. Your employer withheld $5,600. The IRS subtracts $4,800 from $5,600 and gives you a $800 refund. Step 2. How long refunds take. Refund timing depends on how you file and how you request your refund. Electronic filing, e-file, with direct deposit. Usually 2-3 weeks. This is the fastest method. Paper filing with direct deposit, 4-6 weeks. Processing paper returns takes longer. Paper filing with paper check, 6-8 weeks or more. Mailing a check adds extra time. The IRS updates refund status once a day, not in real time. So if you're waiting, checking multiple times a day won't change the information. Step 3. How to track your refund. The IRS has a free tool called Where's My Refund? On their website. You'll need your social security number, filing status, single, married, etc., the exact amount of your refund. The tool will show 3 stages. Return received. They've accepted your return. Refund approved. They've processed it and scheduled your refund. Refund sent. The money is on its way. This tool updates daily, usually overnight. Step 4. Common reasons. Refunds are delayed. Sometimes, refunds take longer than expected. Here are some common reasons. Errors on the return. A wrong number, missing form, or mismatched information can delay processing. Claiming certain credits. Refunds with the earned income, tax credit, or additional child tax credit are often delayed until mid-February due to fraud prevention laws. Identity verification. If the IRS needs to confirm your identity, they may hold the refund until you verify your information. Paper filing. Paper returns always take longer, especially if mailed close to the deadline. Offset for debts. If you owe federal or state debts, like student loans, child support, or unpaid taxes, part or all of your refund may be used to pay those first. Step 5. What if you don't receive your refund? If the IRS shows your refund as sent, but you haven't received it, here are the steps to take. Direct deposit missing. Check your bank details on your return. If you accidentally use the wrong account number, the deposit may have failed. Contact your bank. Paper check missing. If a paper check was mailed but hasn't arrived, you can request the IRS to trace it. Sometimes they'll reissue the check if it was lost. If more than 21 days have passed since e-filing, or more than 6 weeks since mailing a paper return, you can call the IRS to follow up. Step 6. Using your refund wisely. When the money arrives, it can be tempting to spend it right away, but think of your refund as an opportunity. Here are smart ways people often use refunds. Pay down debt. Using the money to pay off high-interest credit cards or loans saves money in the long run. Build savings. Putting the refund into an emergency fund creates a safety net for unexpected expenses. Invest for the future. Consider contributing to retirement accounts or investments. Cover upcoming expenses. Some people save refunds for property taxes, medical bills, or large purchases. Of course, it's your money, so how you use it depends on your priorities. Step 7. Avoid relying too much on refunds. It can feel nice to get a big refund each year, but keep in mind, it means you overpaid throughout the year. Some people prefer to adjust their withholding, so they keep more money in each paycheck, instead of waiting for tax time. For example, instead of overpaying by $2,400 and getting it back in April, you could adjust your W-4 to keep an extra $200 each month. That might give you more flexibility during the year. It's a personal choice. Some people enjoy the lump sum, while others prefer steady cash flow. Step 8. Avoid scams. During refund season, scams increase. Be cautious of emails or texts claiming to be from the IRS. The IRS never contacts you this way. Fake expedited refund offers. Scammers may pretend they can speed up your refund in exchange for money or personal information. Phone calls demanding payment to release a refund. The IRS does not work this way. Always track your refund only through the IRS's official website or app. Step 9. State refunds. Don't forget, if you live in a state with income tax, you may also get a refund from your state government. Each state has its own system and timeline. Some are faster than the IRS, while others take longer. Check your state's official tax website for details. Final thoughts on refunds. Refunds are one of the most anticipated parts of tax season. They happen because you paid more than necessary, and getting that money back is always a good feeling. The key is to know how long it usually takes, track it using the IRS tool, and be patient if delays occur. Most importantly, think about how you use your refund. Whether you save it, invest it, or use it to ease financial stress, this money is yours to put towards your future. Being self-employed comes with freedom, but also responsibility when it comes to taxes. Unlike someone who works for a company and gets a paycheck with taxes already taken out, self-employed people have to take care of everything themselves. Let's walk through what that looks like in a way that makes sense, step by step. First, understand who counts as self-employed. If you run your own business, even a small one, or if you do freelance work, or even gig jobs like driving for rideshare, or delivering food, the IRS usually sees you as self-employed. That means you're responsible for reporting all the money you earn and paying your share of taxes on it. Instead of a W-2, you'll usually get a tax form from companies you worked with. It's often called a 1099 form, and it lists how much they paid you. But here's something important. Even if you don't get that form, you're still required to report the income. This is one of the areas where beginners make mistakes. They assume if no form comes in the mail, they don't have to mention it. But the IRS expects you to count everything. Now let's talk about expenses. When you're self-employed, you're allowed to deduct many costs of running your business. Think of things like office supplies, a computer you use for work, or even part of your internet bill if you work from home. These deductions reduce the amount of income you're taxed on. So, instead of paying taxes on every single dollar you earn, you subtract the money you had to spend to do your job. One important tool here is what's called Schedule C. That's the form where you report your self-employment income and your expenses. You'll need to keep careful records throughout the year, so filling this out isn't stressful. If you drove your car for work, you should track your miles. If you bought equipment, save the receipts. When you're organized, tax time becomes much smoother. Another part of self-employment taxes is something called self-employment tax itself. Normally, when you have a job, your employer pays part of Social Security and Medicare taxes, and you pay the other part. But when you're self-employed, you pay both halves. That sounds rough, but remember, you can also deduct half of that amount on your tax return, which softens the impact. Something else to know. If you expect to owe a good amount of tax at the end of the year, you might need to make quarterly payments. That means 4 times a year. You send in part of what you expect to owe. This keeps you from getting hit with a big surprise bill in April. We'll go deeper into quarterly payments in the next section. So, what should you do if this all sounds overwhelming? The first step is to break it down. Track your income. Track your expenses. Save a portion of your earnings for taxes. And when it's time to file, carefully complete your Schedule C and any other required forms. Many tax software programs walk you through it in a friendly way, asking simple questions to fill in the right boxes. Remember, being self-employed gives you freedom, but that freedom comes with the responsibility to be your own bookkeeper, your own payroll department, and your own tax preparer. If you stay consistent, it won't feel so heavy. Now let's go deeper into quarterly estimated payments. If you're self-employed, or have income that doesn't have taxes withheld automatically, you can't just wait until April to pay it all. The IRS wants its share throughout the year. That's where quarterly estimated payments come in. The year is divided into 4 periods: April, June, September, and January of the following year. By those months, you send in an estimated tax payment based on how much you expect to owe. Think of it as paying your taxes in installments. Why does the IRS do this? Because taxes are pay as you go. Employees have money taken out of each paycheck, so it's fair that self-employed workers send theirs in as they go too. So, how do you figure out how much to pay? There are a couple of ways. One is to estimate your income for the year and calculate your taxes as best you can, dividing by 4. Another method is to pay based on last year's taxes. If you pay at least as much as you owed the previous year, divide it into 4 payments. You usually avoid penalties, even if you end up owing a bit more later. Payments can be made easily online using the IRS website. They have a system called Direct Pay, where you can send money directly from your bank. It's quick, and you get a confirmation number, so you know it's recorded. The main reason to take quarterly payments seriously is to avoid penalties. If you underpay during the year, the IRS may charge you extra, even if you catch up in April. It's not about being mean. It's just the system they use to make sure money flows in steadily. For many beginners, this part feels the most confusing. The trick is to set aside a percentage of every payment you get. For example, some freelancers save 25 to 30% of each payment in a separate account. Then, when quarterly payments come due, they're ready. It might sound tedious, but once you get into the rhythm, it's actually freeing. Instead of dreading a giant bill once a year, you're smoothing it out across the year. And when tax season rolls around, you'll already be mostly paid up. One of the reasons taxes feel intimidating is the stack of forms with strange numbers attached. Let's slow down and make sense of the most common ones. First, The W-2. This is the form employers give their employees each January. It lists how much you earned, how much tax was withheld, and other details like Social Security contributions. If you worked a job for wages, you'll get one of these. Next is the 1099. There are several versions, but the most common one is the 1099 NEC, which reports income from freelance or contract work. Another is the 1099 INT, which reports interest earned from bank accounts. There's also 1099 DIV for dividends from stocks. Each of these tells the IRS you received money outside of a regular paycheck. Another key form is the 1040. This is the main tax return form. It's where everything comes together: income, deductions, credits, and the final calculation of whether you owe money or are due a refund. Schedule. C is the form for self-employed income. Schedule A is for itemized deductions like mortgage, interest, or charitable donations. Schedule B sub B is for interest and dividends. Each schedule attaches to your 1040 like puzzle pieces, something to remember. You don't need to know every single form. Tax software or a professional will figure out which apply to you, but being familiar with the big ones helps reduce anxiety. If you think of forms as tools, it's easier. A hammer looks intimidating until you realize it's just for driving nails. A W-2 looks overwhelming until you realize it's simply a summary of your paycheck. Once you frame it that way, the numbers in boxes stop feeling like a secret code. Owning a home changes your taxes in important ways. One of the biggest is the ability to deduct mortgage interest. This means if you pay interest on a loan for your home, you may be able to subtract that amount from your taxable income. For many homeowners, this is the largest deduction they get. Another major deduction is property taxes. The money you pay to your city or county each year for owning your property can often be deducted as well, up to certain limits. If you made improvements to your home for energy efficiency, like adding solar panels or upgrading to energy-efficient windows, there are sometimes credits available. Credits are even better than deductions because they directly reduce the amount of tax you owe, not just your taxable income. For homeowners who use part of their house as a home office, there may be another deduction if a portion of your home is used regularly and exclusively for business. You may be able to deduct related expenses. This is another area where records are important. Being a homeowner also means you'll want to keep good records of improvements. When you eventually sell your house, those improvements can affect how much profit you owe taxes on. Home ownership can feel overwhelming at first, but when it comes to taxes, it often provides significant advantages. The key is knowing which forms to use and saving documentation of everything you spend related to your home. Tax credits are powerful because they directly lower your tax bill. If you owe $1,000 and you qualify for a $500 credit, your bill becomes $500. That's very different from a deduction, which just lowers the income the IRS taxes. Some of the most common credits include the child tax credit, which helps parents with the cost of raising kids. There's also the earned income tax credit, designed to support low to moderate income workers. Students may qualify for the American Opportunity Credit or the Lifetime Learning Credit, which help offset tuition costs. There are also credits for adoption expenses, saving for retirement, and making your home more energy efficient. The key with credits is to carefully read the qualifications. Many people miss out because they assume they don't qualify, or they forget to claim them. Tax software usually checks this for you, but it's worth knowing what's out there. Think of credits as rewards for certain behaviors: raising children, going to school, saving for retirement, or making your home greener. These are all actions the government wants to encourage, and the credits are their way of giving you a financial boost. If you take nothing else from this section, remember this: always check for credits. They can sometimes be the difference between owing money and getting a refund. Saving for retirement isn't just about putting money away for the future. It's also about how that money is treated for taxes. There are a few main types of retirement accounts, and understanding how they work will help you both now and later in life. The most common retirement account is the 401k. If you work for an employer that offers this, you can have money taken out of your paycheck before taxes are applied. This means the money goes in tax deferred. You don't pay taxes on it now, but you will when you withdraw it in retirement. This can be powerful because you're lowering your taxable income today while saving for the future. Another common account is the individual retirement account, or IRA. There are two main types: traditional IRA and Roth IRA. A traditional IRA works much like a 401k. Contributions are usually tax deductible, and you pay taxes when you take the money out later. A Roth IRA is the opposite. You contribute money you've already paid taxes on, but when you retire, the withdrawals are tax-free. Which one is better depends on your situation. If you expect to be in a higher tax bracket later, a Roth might make sense. If you want the immediate tax break, a traditional might be better. Employer matches are another benefit to know about. Many companies match part of what you put into a 401k. That's essentially free money. Always take advantage of it if you can. Retirement accounts also have rules. You can't withdraw before a certain age without penalties, usually 59 and a half years old. There are also required minimum distributions later in life. which means you must take some money out each year. The important part for taxes is this. Retirement accounts are designed to encourage saving by offering tax benefits. Understanding the difference between tax-deferred and tax-free growth helps you make choices that save money now and later. When you invest in stocks, bonds, or real estate, the profits you make are called capital gains. How those gains are taxed depends on how long you've owned the investment. If you sell something you've held for less than a year, that's a short-term gain. It's taxed just like regular income, at your normal tax rate. If you sell after holding it for more than a year, it's a long-term gain. Those are taxed at lower rates, which can save you money. For example, imagine you buy stock for $1,000 and sell it a year later for $500. That $500 profit is your capital gain. If you held it for more than a year, you'll likely pay less tax than if you sold it quickly. There are also capital losses, which happen when you sell something for less than you paid. The good news is, you can use losses to offset gains. So if you had one investment that gained $1,000 and another that lost $500, you only pay tax on the net 500 dividends, which are payments companies make to shareholders. Are another area. Some dividends are taxed at regular rates, and others qualify for lower rates if they are considered qualified dividends. Real estate has its own rules. If you sell your primary home, you may be able to exclude a large portion of the gain from taxes, as long as you've lived there for a certain period. Investments can be confusing, but the key takeaway is this. The timing of when you buy and sell matters. Holding longer often means paying less in taxes, and if you lose money, you can use that to your advantage at tax time. Sometimes when you file, you find out you owe money. It can feel stressful, but let's break down what to do calmly. First, don't panic. Owing taxes doesn't mean you've done something wrong. It just means the amount withheld or paid during the year wasn't enough to cover what you owed. The first step is to check the amount carefully. Make sure your return is accurate. Sometimes mistakes in typing numbers or forgetting a form can make the balance look scarier than it is. If the amount is correct, the next step is to look at how you can pay it. If you have the money, paying right away avoids interest and penalties. If you don't, the IRS has payment options. You can set up a payment plan online if the balance is within a certain limit. This allows you to pay monthly until the debt is cleared. The IRS charges some interest, but it's usually much better than putting it on a credit card. If the amount feels impossible, there are other programs like Offers in Compromise, where the IRS agrees to accept less than the full amount in very rare situations. These require strict qualifications. The important thing is to communicate. Ignoring the balance only makes it worse. Taking a deep breath, confirming the numbers, and setting up a plan keeps it manageable. Let's go a little deeper into payment plans. If you owe and can't pay all at once, the IRS allows installment agreements. The easiest one to set up is called a short-term payment plan. If you can pay the balance within 180 days, you don't even need a formal installment agreement. You can just arrange to pay monthly until it's done. For longer periods, you can request a long-term installment plan. This spreads payments out over several years. You'll apply either online or by mail, and the IRS will ask about your income and expenses. There may be setup fees, though low-income taxpayers can sometimes have them waived. Interest and penalties continue until the balance is fully paid, but at least you won't face collection actions as long as you're making payments. The most important part is staying current. That means while you're on a plan, you must also file future tax returns on time and pay those taxes too. Missing future payments can cause the plan to default. Think of a payment plan as breathing room. Instead of being crushed by a big balance, you're breaking it down into steps. And as long as you keep walking those steps, the pressure lifts. Taxes come with deadlines, and missing them can mean extra costs. Let's talk about how to avoid those. The main filing deadline is usually April 15th. If you file late and owe some money, there's a penalty called the failure to file penalty. It's a percentage of what you owe, added each month you're late. That adds up quickly. There's also a failure to pay penalty. This one applies if you don't pay on time, even if you filed the return. On top of that, the IRS charges interest until the balance is paid. So, how do you avoid this? The first rule is simple. Always file on time, even if you can't pay right away. Filing stops the failure to file penalty. Then you can work on paying. Another way to avoid penalties is to make sure enough tax is withheld during the year, or that you're making correct quarterly payments. If you underpay during the year, the IRS may add an underpayment penalty if something truly outside your control happens, like a natural disaster. Sometimes the IRS offers relief, but in general, being on time is the best defense. Think of penalties, like late fees on a bill, but worse. They don't just stop when you catch up. They grow until you're fully paid. Staying ahead of them by filing and paying on time keeps more money in your pocket.